Hello, citizens of Gotham. My name is Graham Elwood, and you are watching the Political Vigilante. I told you this in March when the SVB bank went under and they started bailing out the banks, and Joe Biden came on the news and said, your money's safe. I was like, oh no, oh no. And what has slowly been quietly been happening is banks have been denying deposits over the Thanksgiving week. Okay. So when everyone's talking about Thanksgiving and all the news stories are like, what's the best gravy to make or whatever? And oh, there's deals over at the Best Buy and go trample another human being to get a discount TV or whatever the stories were. All of these kind of quiet, like deposits were taking forever to go through. Banks have been closing branches. I'm going to show you a bunch of stories today to show you that, the banks are sort of quietly collapsing. They're trying to keep it. I don't think they want to just announce it like they did in 2008. But remember the timeline. I showed you this in 2008, right? When I think it was the Lehman Brothers or Bear Stearns, whatever that first one was, it went under in March of 2008. And it was like, whoa, this is kind of a big deal. By September of 2008, everything collapsed. And there's been no real protections put in place. Dodd-Frank is, as I always call it, is a Band-Aid on a shotgun. But here is Bank of America branches that are closing in December 2023. Complete list. They're closing branches. Now you might say, oh, this is just because everybody's going online and nobody needs to blah, blah, blah. Oh, I don't know. This was November 27th. Today, right? Bank of America will close several branches by the end of the year. Here's the full list of locations closing in December. Bank of America announced that it will be closing several branches across the United States, with the closure scheduled to take place before the end of the year. Other financial giants such as JP Morgan Chase, Wells Fargo have also closed various locations in recent months, with more closures expected. All right. The popularity of online banks has resulted in major banks closing down physical branches, leaving customers with fewer options for in-person assistance. Oh, okay. Maybe it's just the technology's changing. And then it gives you a list. Okay, that sounds like it could be sort of reasonable. Maybe that's just one little big story. We don't need to turn it into a big thing. Oh, these are all the bank failures. This is from the FDIC. This is the federal government's FDIC.gov. There's an uptick in bank failures, not closing a branch because online, everybody's going online. Failures. Look at this number right down here. That means they're out of money, right? This is in Citizens Bank in Sac City, Iowa, went under November 3rd. It had approximately $66 million in assets, $59 million in deposits. Iowa Trust and Savings to assume all the deposits and of Citizens Bank. Okay, so these are banks that have closed. Heartland Bank, First Republic Bank, we talked about that, was in May. Signature Bank in New York, we talked about that. That was the big ones in March. Silicon Valley Bank, right? That seems like more than just closing branches because everyone's going to banks online. Layoffs sparked by Citigroup's overhaul started this week. Here's the full list of major U.S. companies slashing staff this year. This is from November 15th, the week before Thanksgiving. This year, layoffs have expanded beyond tech, media, and finance, and retail companies also cutting. Layoffs have remained an unfortunate reality of 2023, continuing pace with the cuts made at dozens of companies towards the end of last year. Banking giant Citigroup started planned layoffs Wednesday after CEO Jane Fraser announced a corporate overhaul in September. A final number of how many will be affected by the cuts haven't been disclosed yet. But somebody told CNBC the bank could let go of at least 10% of several major businesses. This is a bad sign. According to its 2022 annual report, Citigroup has recently employed about 240,000 employees. A number of those employees began finding out they're no longer employed on Wednesday. So 10% would be something like 24,000 layoffs, roughly, right? So tech companies have slashed more than 244,000 jobs when they cut 80,000 in March from March in 2020 of 80,000, 15,000 in 2021. Yeah, this seems... Let's check this story out. Almost all loans are bad. Why banks aren't lending. Rising deposit costs and capital needs are making lenders pickier at the cost of growth. This was in September, right? This is in the Wall Street Journal. Then there's this story. Credit card delinquencies continue to rise. Who's missing payments? So I want to kind of stop, show you what all of this means, right? So we've got several things happening here. Layoffs. Okay. So that means fewer people are working. That means there's less money in the economy. Plus the interest rates are high. So it's harder. Less people are buying homes because, 3 years ago, you could buy a home at a 2 or 3% interest rate. Now it's a 7% interest rate. That's significant to your monthly mortgage payment. So then you have all these layoffs, which means people don't have as much money, but consumer debt is going up. So banks are not giving out loans, which means there's just less money for people to borrow and use. Companies can't get loans. It's harder to get a home equity line of credit. People's credit card debt is going up because they're still spending, right? It's the holidays, whatever. So that means people are going to be defaulting on these credit cards. They're going to be defaulting on their loans, which means the banks lose that money. And the banks are closing branches and the banks are laying people off. And I showed you in March how there was like, we're starting a banking crisis. You see how this all ties in? Are all the banks going to collapse? I don't know. It doesn't look good. It doesn't look good. Let's show you another story. Negative equity surges. Millions of Americans now underwater on auto loans. Early signs of a negative equity surge in the auto loan sector have begun to emerge in the first quarter of 2023. According to data from Edmunds, the average negative equity value of auto trade-in was $5,300 in Q4 of 2022, up 29% from the previous year. The number of vehicle sales that involved a trade-in with a negative equity also jumped by 17% over the same period. Well, negative equity is when you owe $20,000 on a car that's worth $12,500, whatever. So the vehicle has negative equity. Oof. The chip shortage of the last several years and other supply chain issues have had a dramatic and well-documented impact on the supply of new vehicles. A resulting lack of availability and increased prices also drove up the price of used cars to record highs in 21 and 22. That means that people who bought used cars during this time did so at inflated prices. Look at this. This is 21 and 22. Look at that. But drastically inflated prices on pre-owned vehicles is only one part of the equation. When prices were at their highest, many people found their cars were suddenly worth more than before, often carrying positive equity. This means that while buyers had to pay more for used cars, used car owners could also sell them for more too. However, used car prices started to fall rapidly toward the end of 22. As a result, the value of many of the cars purchased over the previous 2 years dropped significantly. For many borrowers, the value dipped below so what they're saying, used car prices, because there was a new car, the chip shortage, the new cars weren't available or weren't as many available. So it drove used car prices up. So people that bought used cars were paying, and they took car loans out. Like let's say it's a used car that's normally brand new. It's $35,000, but used, you could have gotten it for 18, but the price drove up to 22. You had to take a loan out on it. And then the value of the car drops. And all of a sudden now you're upside down. The higher interest rates, Wow. Look at these used car rates are over 10% now. They were between 8 and 9%, and now they're over 10. The cost of living. Loan delinquencies are also on the rise. Recent reports would suggest that many have been left without the ability to even meet their expenses, let alone find extra room in the budget to pay more towards their car loans. According to a report from Cox Automotive, auto loan delinquency rates have climbed to their highest levels in over 15 years. Auto loans are considered to be severely delinquent when past due by 60 days or more. The data from Cox Automotive shows that 1.89% of all auto loans were severely delinquent in January of 23, and the highest rate since 2006. What does this all mean? Oh. If consumer debt goes up and there's more layoffs, that means people could eventually just start filing for more bankruptcy and just be like, I don't have this. So then the banks lose the money. And if the banks are lending more money than they have, and then there's a run on the banks, any number of crazy scenarios could happen. People are living over their means, which isn't good. But then what part of that is the inflation. Things are costing more now than they used to. So I said, like, that's why I'm in a credit union. And that's why I own Bitcoin. So follow your money, follow the money, follow your money, connect the dots and get the truth. And be careful, because we could have a huge economic collapse in the United States in the next 3 to 6 months. Be careful. Be careful. That's why I said buy Bitcoin. And shave your knuckles for justice. Boom.